Greetings everyone. Today we'll be solving a question from your exam kit. The question is Grafham Co. It is an adaptation from the March-June 2023 attempt. It is located in your exam kit, question number 310. The question relates to topics of sources of finance and Islamic finance, and we'll be solving part A only today, as part B relates to the topic of Islamic finance, which we will cover in our classes ahead. So let's start. First, I will like you all to read the question so that we can come up with a strategy of what is relevant, what is not relevant, and what is important and what is not important in the question. Okay, I hope you have all read the question. I have marked a few things. You can read them. The basically the company is planning to invest in a new project and it requires 18.9 million of new finance, and they have always used a mix of debt and equity, but are now concerned about the level of Grafhamco's gearing compared with the industry average. Therefore, they are not going to use debt this time. A director has proposed a 2-to-5 rights issue to existing shareholders at a discount price of 25% of current share price of 8.4. The nominal price value of a share is 2 per share. So basically you have the par value, you have the market price, and you have the right issue policy. Now, basically there are two types of shareholders in this company now, small ones and big ones. Small ones are the ones who own less than 5% of the issued share capital per person, and they are a total of 50% of total issued share capital. And there are then the large shareholders who own more than 10% of issued share capital per person, and they own 50% of the total share capital. Now, the small ones are not happy with this decision of right issue because they do not have enough money with them. Whereas the large ones are happy, but they have a condition that they want the new project to earn at least the same operating profit margin in percentage terms as Grafhamco's current business does. Now, and then we have the corporation tax of 16%. We have the values of market value of loan notes, and we have the industry average P ratio. And also one more thing, the question says that the company's P ratio can be assumed to be unchanged by undertaking this project. So basically, if you take this project or do not take this project, your P ratio will be remaining same. This is an important thing as it will help you in calculating EPS or new price. Now, we all have read the things. The last line is basically that the new project is expected to earn 20 millions in revenue and has an operating profit margin of 18%. If the project is successful, it is expected to be to open more opportunities to invest in further projects. Now, we'll start with Grafham Co. Part A. I. That is theoretical X rights share price, also known as TERP. Now, basically what is theoretical X right? It is the price of a share after the right issue has taken place. Okay, now let's solve it, shall we? Okay, so we have what is our share capital number? Okay, what is our share capital number? Our total number of shares is how much? is equal to 15,000,000 divided by 2, because our ordinary share capital is approximately 15 million and the nominal price per share is 2. This gives us how much? Approximately 7.5 million. Okay. And the market value of share capital is the number of shares multiplied by what was our actual price per share before the issue, 8.4. 63 million. Now, number of rights issued multiplied by bracket open 2 divided by 5. Around 3 million shares are being issued as right issues, and they are being proceeds from right issue. First of all, we have to mention that this was 8.4 per share, and this is multiplied by 75%, 6.3 is equals to this multiplied by this. This gives us an 18.9 million of proceeds. Now, what is the market value of total share capital is equals to this plus this, 81.9 million. Number of share capital is 7.5 plus 3, and now our TERP is equal to this divided by this. Gives us how much? This is a rounded off figure. Wait, let me put the number formatting here. This is our answer of part A1. Now, let's solve part A2. That is current earnings per share. Before investment. Now, what is our PBIT here? Profit before interest and tax, 9.5 million. And our finance costs is 8% of 25 million is equal to 8% of 25 million. And let me just put a minus before 8. This can be a cost now. And we have profit before tax, that is this plus is equal to sum bracket open bracket close 7.5 million of PBT. Now our tax expense is 16%. That is 1.2 million. Multiply that minus 16%, 2 million. Now we have profit after tax, that is sum bracket open, this with this, close, 6.3 million. Now our number of shares was how much? And our EPS will be is equal to this divided by this, 0.84 per share. Okay. Now we have calculated the current EPS. Now our part A 3 is revised EPS. This is going to be our PBIT first, and this is our PBIT, profit from new project, 18% multiplied by 20 million. Revised PBIT is equal to sum bracket open, this plus this bracket close. 13.1 million is our revised PBIT. Now our finance cost is going to remain same, that is this, and our PAT is going to be is equal to sum bracket open, this with this bracket close, 11.1 million. Our tax is going to be 16%. And our PAT is going to be is equal to sum bracket open, this with this bracket close, 9324,000. Our number of shares is going to be how much? 10.5 million. So I'm just going to use is equal to, and I'm going to select this cell of number of shares from part A1, and my EPS is going to be is equals to this divided by this, close, 0.888. Now, and we have to calculate the share price of revised EPS and share price after investment, assuming the right issue was successful. So now our PE ratio before investment was this was our price before issue was 8.4 is equals to 8.4 divided by earning was 0.84. So our old PE ratio was 10, and assuming that our PE ratio is not going to change according to the question, my revised EPS is this. So my revised price of share is going to be this multiplied by this is 8.88. Now, what is part A for? Part A4 is calculate the current gearing and revised gearing after investment in the project using market values and assuming the right issue is successful. So remember, you have to use the market values. So part A4 is current and revised gearing ratio. So first we're going to evaluate current gearing ratio. Now, non-current liabilities divided by non-current liabilities plus equity. That is our gearing ratio formula. So our market value of non-current liabilities is equal to, okay, our non-current liability is 25,000, so 25,000 multiplied by what is the market value of that is 110 per 100 loan note. So I'm gonna multiply it by 110 divided by 100, and this was 25 million. And our equity was our equity was 7.5 million shares multiplied by 8.4 per share. Gearing is going to be is equal to non-current liabilities divided by bracket open non-current liabilities plus equity. That is this needs amendment multiplied by 100. %30.39%. This was our current. Now, revised gearing. Our non-current liability is going to remain same. Our equity is going to change. That is, how many number of shares do we have now? 10.5 million, 105000000 multiplied by this was our revised share price, bracket close. This is our current equity is equal to gearing is equal to this divided by bracket open this plus this bracket close multiplied by 100. Wait, I'm going to do this instead and format it as percentage here at 22.78%. Now, this was your practical side of all the 4 parts of this question. Now I'm going to discuss part 5 only because it holds a huge chunk of marks. Okay, so basically the question says discuss the views of directors and the directors and both the small and large shareholders in relation to the new project and its financing. Okay, so directors have a point that because our gearing is very high and the industry average is around 25%, so we are very high in the terms of gearing and we should try to decrease it somewhat so that we can be nearby the industry average. So the current level of gearing exceeds the average industry gearing, which does concern the directors. However, the right issues impact would be to take the gearing below the industry average. The new gearing would provide the directors some scope to obtain loan finance if they need to invest in future projects. So now we have cleared up with the directors that okay, if you have a successful right issue, your gearing will go below the industry average, and then you might have some gap, you might have some scope to obtain a loan finance so that you can stay under the industry average and be beneficial for both the groups of shareholders. Small shareholders. So basically, small shareholders do not have funds to subscribe to the right issue. So the small shareholders do not have to subscribe to the right issue. They could always sell their rights, and selling their rights would lower their shareholding in Grafham Co. However, as their percentage holdings are already small, it would be unlikely to make any difference in the influence. However, they could benefit by the gain by selling their rights, that is TERP minus revised share price. That would be 1.08 per share. And so basically what happened in the case of small shareholders, that you do not have enough funds to buy the rights right now. So you always have four options. You can either buy, you can either sell, you can either buy half and sell half, or you can do nothing. So you have to just discuss this thing that okay, if you do nothing, your shareholding will decrease, but obviously because you are already a small shareholder of the company, so a decrease in the percentage of holding will not in fact impact your influence on the company. However, you can sell your rights to someone outside and gain from them. Okay, and how much gain will you get? Because your rights are of, let's say, how much is the term right now? 7.8. So you're going to get your rights from the market for your shares. If you buy them, you're going to buy them at a discounted price. Your theoretical extra share price, or you can say your average price of the shares, is going to be 7.8, and you're going to sell them in the market for 8.88. So obviously you're going to gain $1.08 per share by selling your rights to the outside people. Now, in the case of large shareholding, you have to discuss with them that okay, how much is the operating margin and all, because it was stated that the large shareholders have a condition. So the current operating margin is at 21%, which means the new project would not meet the large shareholders criteria. However, the new project would earn profit and result in a capital gain, assuming the PE ratio remains same. This project will result in a long-term increase in the shareholder wealth, as the increasing share price will increase the shareholders' wealth, and it has a positive NPV as well. And it is also a gateway to new investments in further projects of the company, as it was stated in the question. So basically this question was around the impacts and what a shareholder can do with their rights, the point of options with your rights issues, and from the facts stated in the question that okay, what are the concerns of the large shareholders, what are the concerns of the small shareholders, and what are the concerns of the director. You have to discuss them only. that was it. Okay, I'll try to send this file, the Excel file, and I'll try to also attach this highlighted question file in the LMS, and I'll upload this video in the LMS as well. Till then, you guys take care, enjoy, and study hard. We have already covered approximately more than half of the syllabus, and I am not getting enough answer scripts from you guys. So try to solve as much questions as possible and try to send me the answer scripts so I can mark them and check them and tell you where do you need correction and where do you need improvement. Till then, take care and study hard.